All right. Good evening, good morning, good afternoon, wherever you are on this awesome planet. Welcome to the Inner Circle Live Asian session. I'm your host for tonight's session, Benny Allen, and I'm definitely grateful and happy for all of you, as always, to be here with me tonight as we take a look at the technicals and the fundamentals to see what we can take advantage of in this Forex market. So, as always, without further ado, let's make sure that we turn off any and all distractions. Grab a pen and paper, take lots of notes, and let's make sure that we continue to do an amazing job of participating and engaging. It's actually the fastest way to learn. So, I know when I was learning how to trade these markets, the training was one thing, right? But the training is static. But what really helped me turn the corner was joining the live sessions, right? Either live or watching the recordings to get my questions answered if I was live, or watching those recordings to get those mental reps. That's what really helped me to shorten the learning curve. That's why the platform is set up the way it is, right? You eventually have to dive in, right? Jump and grow your wings on the way down. And that's what it's all about. So if everybody is ready to go, do me a huge favor, drop me a one in the chat. Let me know you can hear me loud and clear so we can get this session going. Awesome. I appreciate the early participation. So let's talk about it. Let's talk about some things that happened today. Over on the Forex Factory, we had ADP, right? Which looks at private sector employment data. And for the United States, it came in above forecast. So we still have a tight labor market, right? Which we all know now, right? That fundamentally that means the Fed is just another data point that supports the narrative of rate hikes, right? And we know that in Powell's testimony on day one, saying, hey, if we have to raise them at a faster pace, right? And then once we get to that neutral level, whatever that's going to be, which now we know could be higher than what was originally thought, right? For the longest time, we heard 5%, 5.25%, 5.5% on the high end. But it can even be higher than that, and it can stay at that level for a lot longer. So when we see things like ADP non-farm payroll, private sector coming at 242 on a forecast of 197, hey, that supports that narrative. But now it's going to come down Friday to non-farm payroll, okay, which is not the first Friday actually this month of the month. This time it's coming up at the end of the week. So we may, right? Don't be surprised, right? If you all start seeing the markets bounce around and you're not getting that price action. A lot of times when you have big reports that are going to come up towards the end of the week, middle of the week, you see that market, sometimes you won't see as much price action. So don't be surprised if some of the positions you may be in may bounce around for a little while. Some of those swings, that's just how it goes, right? As people wait for those numbers to come out. Another important thing today was the Bank of Canada came through as expected, and they actually held rates. So for the first time in 9 sessions, the Bank of Canada did not raise rates, right? So they held them. And so now you got the Bank of Canada holding rates. You have the United States looking to raise rates potentially at a faster pace moving forward, and a neutral rate that can be higher, okay? And now we've got jobs openings, with the number of job openings that came through slightly higher than forecasted in the United States. So we still have a very tight labor market, right? When we keep hearing Chairman Powell say the pain, right? Wage depression, right? The pain in regards to the jobs, right? Somehow, right? Just in the tide of inflation, we haven't seen a huge impact in that area yet. Okay, now we're starting to see it in the tech sector. Okay, you're hearing that more and more about massive layoffs, but tech, a lot of times that's when you start to get either a slight turn or a major turn in the economy, that tech, right? That capital that's needed for research and development, that those capital flows, right? Those investments flows start to decrease, right? You can see those job losses and things like that, and budgets being cut. So that Joe's job openings for the U.S. came through higher than expected. There was right here. So BlackRock, major investment firm, says the Federal Reserve can hike rates to a peak of 6% now, right? 6%. Okay. So yeah, if you haven't had a chance to watch Chairman Powell's testimony, especially day one, definitely if you get a chance, take a look at that. It's quite interesting, all the back and forth and the political chicanery that went on. Right. Sometimes it could be a clown show, but Powell kept his cool. So the whole point, right? We saw crude oil inventories, right? So we're seeing some increase in supply, which means, right, that you may have a decrease in demand, right? So we've got increased supplies coming in. So we see that oil, okay. As a matter of fact, let's click over to the chart. That's the DXY, but let's look at oil real quick because hold on, gotta reset this. If we take a look at crude oil, our range play was correct, right? So we found this as support and said, hey, we got a range play back up to this level. And it actually went beyond, right? Went back up here to this $80 level. And then now we've got a correction. So right now in the short term, we've got the oil price moving down, right? So we saw fundamentally, hey, we've got increases in supply, right? So brings concerns about overall demand. Okay, so we've seen oil push down. So we know, right? At least a lot of us, right? Maybe some of our newer folks, you may not. When we look at Canada, and now they've paused the rates, and we know that rate hikes are typically positive for a currency. They decided to hold rates and not increase rates. And we see the oil prices falling off. So the number one commodity for Canada is what? Somebody tell me, either in the chat, take your microphone off mute, let me know. Oil, right? Great job, oil, right? So we've got the Bank of Canada holding rates, oil prices are down, okay? So we can't be surprised if we see, in regards to the Canadian currency, that we see some depreciation, all right? So what we had to start to think about is monetary divergence, okay? Monetary divergence, where we have the United States looking to hike rates, okay? And you've got a lot of fears, right? So if we go over to investing.com and we see the stock market today, Dow slips on Fed fears after fresh signs of a tight labor market, right? We just saw those numbers. So we started to piece this narrative together. So the data points that a lot of investors look at is continuing to support the narrative of more rate hikes coming from the Fed, okay? Whereas in Canada, we are holding rates. We've got oil prices that are down. So we've got a divergence there. And so now we want to be able to see, can we take advantage of that? So you can see here on this dollar CAD, okay, price has finally, right? It retested it before and got rejected at this 137 level. Now we've pushed through that 137. So now we start to begin to think going forward, as we put the fundamental pieces together, is, hey, we've got this monetary policy divergence. We've already come into a sweet spot and pretty much double bottom. So I'm thinking, right, a continuation, long, okay? I know the market's been back and forth for the last, few years now. But, right, we think overall more bullish movement, okay, as these outcomes, these possible outcomes start to get priced in. JC.
Hey, Benny, how's it going?
Good, how are you?
Good, I'm doing well.
Awesome.
So could you explain a little bit, as much as you can, a little bit more about divergence and what that means? This is really the second time I've heard it this week, and I'm kind of still unsure about what it means.
Yeah, so that all it is it's a divergence, right? So you hear a lot of times when it comes to fundamentals, but you also hear about it technically too, right? So from a technical perspective, sometimes you'll start to see, you will see whether it's a MACD, a lot of people use a MACD for it. Some people use normal stochastic for it, where pretty much from a technical perspective, you'll have your momentum on one of your indicators starting to move to the downside while price is still creeping its way up, right? So that's a divergence, right? They're moving in opposite directions. You get what I'm saying? So when you start to see that, right, that type of divergence, you start to think, yes, price action is still moving up, but my indicator is starting to turn over and the momentum is starting to slow. So we may be topping out and we're looking for a correction. You follow me on that? So,
I'm sorry, my internet connection went out and I
oh,
lost
okay.
you for a minute. I
Okay,
heard
that's okay.
divergence and then I heard tools.
Okay, okay. So from a technical perspective, when you hear it, okay, can you hear me?
Yes, I can now.
Okay, so from a technical perspective, a lot of times when you hear about divergence, is when you've got two things moving in the opposite direction. So in a technical perspective, at times it could be price and momentum, right? So a lot of times when you look at like your normal traditional, like your stochastic or like a MACD. So you will hear a lot of times like I'm showing divergence on the MACD where you may start to see lower lows and lower highs on your MACD or on your stochastic, but your price action is still making higher highs and higher lows. So what that can tell you sometimes is that, hey, yes, we're still moving up, but that momentum may be starting to slow and we may get a reversal.
So how do you stand on like that it's a divergent versus your indicator is just lagging? Like how do you know what to trust in that sense?
In that perspective, that comes down to your trade strategy and you're back testing your tool that you're using for divergence.
Okay.
Right. So people that use that, they've used that over time.
Okay.
Right.
Okay.
So you may start to see, for example, right, this start to move, right? And you start to make these lower lows. You see how you got these lower lows and lower highs there? But you may have still been at that point still moving up.
Okay.
Right. So that can kind of key. So it all goes back to your back testing, which whatever indicator tool that you're using to kind of build that trust for that system in regards to using it as a confirmation tool.
Okay.
Right.
On the fundamental side, because that's what I heard.
Yep.
I was looking at the video earlier and I had no idea what was going on.
Yeah. So on the fundamental side, when we talk about monetary policy divergence, you got your central banks moving in opposite directions, right? So it's the same concept, but with just on from a fundamental perspective. So you remember months and months ago where let me go, let's look at this. Okay. And it really happened across the board. But if you remember when this here, if we come back, you see this long run up there. Yep. That's a classic case of monetary policy divergence where the dollar was just a bull in a china shop running wild, right? Aggressive, right? People were buying the dollar. But you remember the Bank of Japan just kept hold. They said, nope, we're keeping our monetary policy. We're not raising rates. We're staying negative. We're not bringing rates to neutral. We're not doing anything, right? And it just kept running. It just kept running. And you remember everybody was saying, oh, we got to watch. What was the round number? It was 150. Remember?
I do remember that. I do remember
you know what I mean? Yeah, and it just kept running. And the Bank of Japan kept sending signals like, oh, they kept threatening, like, you're going to force us to step in, right? And they hadn't done it since like 98. But then they had to do what? They had to stop it. They had to step in. The Bank of Japan had to step in to correct, because what happens is investors, people get greedy. They're just going to make a run on the yen. They're just going to run it. And this just kept running up and up and up and up and up. And that's going to put pressure on Japan's economy. That's going to put pressure. Yeah, that's going to put pressure on their businesses, right? Because they're losing value. Their currency's losing value. They can't get the most bang for their buck. So they step in. And you see right up around this level, you see what happened?
Yep.
How it brought it right back down.
Yep.
Okay. So that's a divergence. So now we're talking about, well, wow, we've got the United States where first investors, the speculation was, remember coming into the year, even though the Fed was saying it's not going to happen, speculators were saying, you know what? They're going to slow down the pace of rates, which they did. They went from a string of 50 basis point hikes consecutively to 25 basis points, right? In the last meeting. And hey, we're going to be data dependent. Well, now the data is saying, man, we may have to get more aggressive with the pace that we're raising them again, because wages are sticky. The job market is tight. So they were speculating coming into the year. And when remember when the stock market came into the year like gangbusters, right? Just a couple months ago.
Yeah.
Because everybody was like, the speculation was, we're going to walk right through this. They were betting against the Fed, saying that they're going to eventually have to pause rates. And then towards the end of 2023, they were going to cut them. They're going to cut rates. Well, now, right? Seems like everybody, not only raising them at a slower pace, they're looking at being more aggressive with the pace. You know, so now you have where the United States is saying, hey, we may have to get more aggressive, whereas Canada is saying we're holding rates where they are. Right? So now that could lead to what? A divergence, right? In monetary policy, because Canada's holding, the United States, you got the possibility of them not only hiking, but hiking at a faster pace now. And that neutral level may not be 5, 5.25, 5.5. You see, the BlackRock official said possibly 6% now. So if interest rates really help drive currency, right, especially in the United States when you've got bonds, right, your 2-year, your 10-year, right, we've looked at that. And so you may get capital flows, because if the stock market is uncertain and just by its nature is more risky, and people get into the stock market because you can get more aggressive returns. Well, if I could get 4 or 5% on a bond for a determined amount of time, I might allocate some of my portfolio to, right, a bond, right, and those fixed securities. So that's what you're seeing in the ebbs and flows. But if people are going to invest more in U.S. bonds, you have to use U.S. dollars, correct?
Yes. I'm sorry. I'm talking
Right?
to you. Yes.
That's okay. Right? You have to use US dollars. So if I'm a foreign investor, I'm like, hey, man, I want to invest in the United States, a bond of full faith, right, of the US government and security of the US government. I'm going to lock that rate in and invest, right? And it's more complicated than that, but it's just a simple narrative. Well, I have to transfer my currency into US dollars to get that bond, right? So you see the dollar, right, strengthening, because the currencies a lot of times are driven by the interest rate and the monetary policy. So if the dollar is going up with interest rates and the Fed and the central bank is saying we're going up and Canada's holding, you may continue to see, right? For one, we see the UJ, since it's found support, is moving up, right? That's a divergence there, right? Will it move in waves? Yes. Can we still possibly get this correction? Yes. But at the end of the day, when we get that low price, we probably should be looking to buy, because of what we know fundamentally in regards to the monetary policy between the BOJ and the US government, okay, and the Federal Reserve. Okay. So that's one instance. Now, when you look at this UCAD, okay, we see that dollar is pushing against it. Okay? So oftentimes when you have two currencies that are, both of them are weak or both of them are strong, right? You get that ranging and that consolidation. Well, you can see how this is breaking out to the upside. Okay, starting to separate itself a little bit, right? The strength of the dollar versus the Canadian, okay, the US dollar versus the Canadian dollar. So we've got this move up. So if this is going to continue to be the narrative moving forward, right? Yes, we're going to have our corrections, but overall, the direction, we're looking forward to continue bullish, right? Will we have our 80-20 plays and things like that in between? Yes. But at the end of the day, we want to see a decent low price, and it's up to you as a trader what you want to take advantage of. Okay. We've got a D extension hit. We're going to get a new fib on this 4. Here's my low point. Here's my AB boundary. Lowest point between the A and the B boundary is my C. And we just hit that D. We do not have a confirmed swing high yet. At some point, we will. You'll get a new fib. And now the game starts all over again. And we're looking for a correction, either off this B boundary, 80-20 play, whatever it is. Once we get to a low price, and we've got this, the Bank of Canada holding rates, US dollar looking to increase the pace of rates, then we're going to look to get long. All right. It's a great question. It's a great question. We know that the ECB, the European Central Bank, is pretty hawkish with their rhetoric right now, okay, in regards to their monetary policy. 50 basis point hikes coming up, right? That's what everybody's pricing in right now in the euro in regards to monetary policy in the March meeting. So when we look at something like the EuroCAD, right, you start to put these pieces of the puzzles together, right? These things are already being priced into the market. Right? So right, if we go to the EuroCAD, we can see, look, see how we're gaining that momentum. It's found support and we're gaining that momentum to the upside. Okay. See here, how it's just moving. Right? So on the daily, we've never gotten a 382, right? And hey, yes, we've got the possibility of head and shoulders, but we have to be aware and we have to know that there's no technical structure that will ever stand in the way of a strong fundamental occurrence, right? So if you continue to see those oil prices go down, we know that the Bank of Canada is going to hold rates. We'll continue to look at the fundamentals, right? The economic numbers, those key numbers for Canada, right? So they're starting to see some things slow down. That's why they held the rates in regards to their economy. Europe is saying, hey, we need to be more aggressive to combat inflation. 50 basis points is the height. So we may not, if we break through this level, you may not see a correction. Right? That's just the way it goes. You may not get that. But at the end of the day, right, when we look at the fundamental narrative, here it is on the 4, right? You can see how that's just pushing. Okay, and you can see we're coming into those highs again. But we're not going to be surprised if we don't get a correction on this, right? Fundamentally, what's going on with the CAD, it may just continue to move long, and that's okay. What we have to do is navigate these charts and say, okay, well, if that doesn't work out, where's my next opportunity to potentially get in and get long, right? So we were drawing up here, okay, the possibility, right, of you do have it, I mean, of your head and shoulders, right? But is there a possibility that that may fail? Yeah, right? Considering everything that's going on, right? It may fail. Do that. So screen disappeared on me. So we see the technical structure and the setup. We just want to be patient to see if we can, what's going to happen, right? Now, we're coming into a de-extension off this impulse move to the upside. Okay? And that comes right in line around these levels, right? But it may retest and just continue and break right through that 146.43 level, that weekly level, right? That we don't predict, right? We just wait and see and we remain patient. But overall, right now, we have been moving bullish, okay? We've been moving bullish. And the fundamental narrative supports a continued bullish move on that, okay? So we've got a slight we've got a discrepancy with the technicals and what we're seeing in regards to a pattern, and then what could ultimately happen. If the pattern fails, it fails. Right? So there's nothing that I would jump in long right now or necessarily look to short right now. Let's just wait and see how the momentum carries. Because if it does want to get short, we got a long way to go to the downside. Okay, so we can continue to be patient with that. But we see this last ABCD move, right, to the upside here on the one, right, off that leg. So it could be taking us into, right, and forming that right tip. We just don't know yet. We just don't know. All right. So some things to keep in mind. All right. Everybody follow me on that. Drop me a 2. Any questions? Further explanation? Okay. All right.
But just a quick one.
Sure.
In reference to the Bank of Canada holding their rate in this month, you made reference to 9 sections. They haven't done that, and I just wanted to know how relevant what a session is and how relevant it is to trading.
What, the sessions? Well,
yeah.
The sessions, how it's relevant to trading, because that's when they talk about the sessions, they're talking about those meetings that they have as a central bank, right? So when they have those meetings, that's when we're looking for not only the rate hikes, right? Which a lot of times going in before, those rate hikes have already started to be priced in. What a lot of people want to know coming out of those sessions is what it looks like going forward, right? Because they're always forward thinking. And the big boys are always with their models, they're way ahead, right? So that's why you always see 2 things during these sessions, right? You see the rate, okay, decision, but then you see the statement. And it's always about that rhetoric in the statement, So a lot of times you'll see those, they're very, very important because you look for shifts in rhetoric. It may go from, hey, we are looking to hike rates to it's a possibility we may hike rates. Or it may go from, listen, we're looking at hike rates to, oh, well, going forward, we're gonna hike rates this time, but going forward, we're gonna be data dependent. So there's no guarantee. You see what I'm saying? You look for shifts in the rhetoric coming from these central bank leaders. So that's why those sessions are important. Right. So you can see here the article, you can see the Bank of Canada kept interest rates unchanged for the first time in 9 meetings and said it's still weighing whether additional hikes will be needed to rein in inflation. Right. So it's weighing whether it'll be needed. So going forward, it's like, they might not hike them, right? There's no guarantee, right, that it goes to 5%, right? Or 4.75, right? 25 basis points to another 50, right? Macklin made good on a January pledge to hold the benchmark overnight rate for 4.5%, the first pause among major central banks that was expected by both markets and economists. Officials kept the door open to more hikes, however, reiterating that they are willing to raise borrowing costs again if necessary, right? So you have to pay close attention, right, to the rhetoric that they use. So that's why those sections. So the first time in 9 sessions. So so here's what we have to remember, right? Coming out of, the crash, right? 2008, you had rates go to 0, right? So to have rates and stuff like this, I know a lot of people are freaking out, but historically, when you think about rates, you're looking at 4, 5, 6%. It's just that the markets have gotten addicted to cheap money, right? Low borrowing costs. So for the time being, that's coming to an end. right? So now, right, we're paying close attention to these rates because it's just like, I need to know what I'm working with, because based on how this goes is going to determine how I'm allocating my capital, how I'm shifting my portfolio, right? And the ebbs and flows and the back and forth, right? So that's why all of this stuff is important. And it's important to us and everyday people because these baseline rates affect everything. Mortgage rates, right? Expansion. If I'm a corporation and I want to expand, open new facilities, things like that, which can create jobs and all types of stuff, right? I may be tightening a little bit, because if it's costing me more to borrow money, right, then I may not be as aggressive in expanding, right? Because it becomes more expensive to borrow money when we're raising rates. Everybody follow me on that? Drop me a 3. That makes sense, right? It's just like you buying a home, right? Oh, I don't want to refinance. The interest rate is 6%. Right? So a lot of times, people don't understand the significance and how bad things were in 2007 and 2008, and the extremes that they had to go through to keep things afloat, to moving into that depression type of environment. Right? They had to take extreme measures. They had to cut rates to zero, lower, print all types of money. Right? Then think about that. From 08, if you look at the S&P 07, 08, and we all know better now as investors, right? We're not just gonna freak out like everybody on the news, right? And panic, because when everybody was freaking out, that's when investors were buying, right? So you can look at the S&P and how it just went straight up from 08. It bottomed out and went straight up. Then 18, you had a correction, and then you look at 2020 with the pandemic, right? If we remember and we look at the chart for oil, when the pandemic hit, oil went to zero. Think about putting a trade in there and letting it run. It went to zero. So sometimes we live in these 24-hour news environments, and the stories come and the stories go. And sometimes when we're in the bubbles that we're in, we don't realize like how significant some of these things are, right? From a historical perspective, right? So now, right, where those rates are starting to go up now, when everything levels out, there'll come a time, right? So if you own a home and you're like, man, I want to refinance, I've got equity in my home, I'm holding for it. Eventually, because the economy moves in cycles, eventually the feds will pause rates, eventually the rates will come back down, and then there'll be all types of incentives and mortgage programs and all types of stuff to get you to buy or refinance, right? We've lived through this enough to know, right, these cycles. But a lot of people don't realize that it's systematic, right? It's systematic. It's almost like a puppet master pulling the puppet strings, right? So we have these recessionary phases and the market recovers. Then we have these bust periods, and then these boom periods and expansion periods, right? And the cycle just goes over and over and over again. And that's what we're living through, right? It's fascinating. It's fascinating. So we're just every day, every week, every month, we're just creating those historical, right? Those historical landmarks that you were here 20 years from now and go back and they'll say, we're back in 2023 when the Fed did this, so, and you'll remember that, right? So that's what it's all about. That's what's going on. And a lot of people think, I want to pay attention to that, but it really affects everything that you do, right? Because a lot of times, because of these rate hikes, these costs get passed on to the consumer, right? When you're printing a lot of money and you've got people working, people who work, typically they spend their money. We're trying to curb inflation. People keep spending, right? They can't get enough people to go back, right? So when you look at something like the JOLTS job openings, and it's like, wow, like there's still jobs being created. There's still jobs openings. Well, we had this whole great resignation thing and we can't get people to come back to work. How do you incentivize people to come back to work? You pay them more money. If you pay people more money, what do they typically do? They spend it. What's that gonna do? Continue to heat up the market. That's why you keep hearing Chairman Powell, he keeps saying, man, we still have a tight labor market. Wages are sticky, right? So it's just this cycle, right? And you definitely don't want to get caught, you know, in a wage spiral, right? Where you got inflation going up, prices keep increasing, and the back and forth and the ebbs and flows. So that's why all of this, that's why we pay attention to it. Because we feel that is important. And a lot of times, even if you're a majority a technical trader, it just makes more sense when you see things get to certain levels and you're like, man, what happened? Like, why did it correct? Why did the dollar yen at 150 make that huge correction? Well, now you know. Now you know. Any questions on any of the fundamentals that we covered? Great questions, everybody.
Hey, Benny, I don't have a question about the fundamentals per se, but if you had some tips on like how we could, or how do you study, or not study, but like log your information with the different with the different, I guess, markets or countries and how you keep up with it.
Yeah, the major thing, the Financial Times, I use a lot of trading economics, right? A lot of trading economics, because when I read these small, right, articles here, so it's expected, that can lead me to, a lot of times that leads me down that Google spiral of saying, well, let me find out more about this, right, in greater detail. So a good place to start is trading economics, right? So you can go in and like, if you want to find out like what's going on, you could go in and say, well, here's commodities. I could go on crude oil and they're going to tell me exactly what's going on. Mm-hmm. Like right now, right? It held below 77. Why? Right? It's telling you that. Right there. And that's the beautiful thing about technology and having this stuff at your fingertips now. And then always used to be like that. If you want to find out what's going on, what happened with that Euro USD, it's going to tell you right here, fundamental. Okay. Right? The DXY. I didn't know you can click
on that stuff on the side. I thought that was just like, was changing.
Yeah.
To do that.
Yeah. Okay. Yeah. So when I'm doing a lot of research for like the newsletter and things like that we send out, I'm going back and forth a lot of times trying to see, okay, is the narrative the same? Another thing too, right? And it's good we're spending time on this today, is when you see this RBA rate statement, if you click on that folder, it's going to put you in the other articles. Right? Okay. You see all this here? Mm-hmm. So it becomes easy.
Stuff I never pay attention to.
I know, right? right? But it's
I really thought it was spam. That's crazy.
Mm-hmm. Reading. Yeah, because what this is doing here, and that's how I got the idea for the newsletter. You know,
which is amazing, by the way. Thank you so much, Benny.
You're welcome. You're welcome. You're welcome. I appreciate it. Appreciate it. And we get that because you see how this is Forex Factor, right? Mm-hmm. This is the Forex Factor. But you see how they're pulling articles from all other type of sources.
Okay.
Right. So these are all different sites.
Okay.
Right. So that's how you gain your knowledge.
All right.
Is do stuff like that. So another thing I'll go to is if I go to Google and I go to Japan Times, right? So we're global now, and I think that's amazing, right? So I could go like, this is the Japan Times, right? So I can find out, you know, what's going on. Like if I go to Pound Sterling Live, right? Whenever that wants to change, look.
Okay.
You know, so it's always that the levels of learning, right? You don't know what you don't know. But once you know what you don't know, the ball game changes. Mm-hmm. You know, so then you can go and look for those things. Investing.com. You know, all of these stories here, right? And you get used to being able to just gauge them real fast, you know, look at the rhetoric, and you kind of start to build a picture for yourself on what's going on. All right. So that's it. that's pretty much how, how I learned it. It's kind of just became a geek.
Do you log it? Like, do you write it out, or do you like put it in a system, or you just look there and like, or that's what you do? You make the letter.
Yeah, I do with the newsletter, but I do a lot of like I have my legal pads.
Okay.
And I'm jotting stuff down. Another thing that I listen to is one of my mentors always taught me, right? Turn your car, any of your free time into, turn it into a university situation. So like I have XM radio. It's like $15 a month, right? So I subscribe to XM radio in my phone for the app. So not just in my car, I use it on the app, right? So one of my favorites is Bloomberg radio.
Okay.
So I'll go to Bloomberg, right? I'll go to Bloomberg Surveillance and listen to those shows. And that's how you learn. Like in the beginning, you're gonna be like, I don't know what they're talking about. But eventually you'll pick up on it and be like, oh, this is what they mean. Because they're bringing in like people from top financial firms, letting you know what their outlook is and what they're saying in regards to currency and different assets. Right. So that's how you gain. I've just always been, from playing sports, like when you want to learn something, you just immerse yourself into it. You just become it, and that becomes your environment. And it just is fascinating to me. So that's what I'll do. You can even go to YouTube. If you go to YouTube and type in Bloomberg Surveillance, the entire episodes come up.
Okay. All right.
Yeah. You're welcome. Any other questions on that?
Nope.
All right, we're good. So I want to go through. I just want to take a look at how. I'm sorry. Somebody say something.
I said I like the part about being a geek.
Yeah, that's me, man. Like I'm going, when I play ball and I play football, like I'm in the film room, on my lunch breaks, after practice, before practice, that's just how I learned. I needed to be in front of it all the time and make that my world so I can try to master it, and Ryan's the same way. And that's why we'll call each other, or he constantly all day will send me like, he'll share YouTube links, like, check this out. Did you hear what they just said? So, and we just subscribe to anything that we can get our hands on that makes sense. So that's how we learn this stuff. To try to create a greater edge, right? So I want to look at, so we know the DXY, what it's doing. I wanted to just check in on a couple of these setups. We looked at the EuroCAD, the USD CAD. We know what the dollar yen is doing. I want to take a look at this NZD USD. Because overall, you can see, right? So this is moving to the downside, how we broke this level. Okay, so we're bearish. We can see that, hey, we're having a bearish week and we're moving down. We know why, right? The dollar's the counter currency in this pair, right? The dollar is strengthening. Now, if you start to we know that the New Zealand dollar is a commodity currency. If we're looking at global demand concerns, right? So it got a bit of a boost because of China and the reopening. It got some positive numbers, but then China spun back and then they got some not so positive numbers in another area. But everybody is still, for the most part, anticipating the global economy to get a boost from the overall reopening of China, right? The timing and how that plays out on the charts, right, is something that you can't predict, but New Zealand could benefit from that because China is their number one trade partner, right? And the same thing for Australia. So we're still looking for long-term benefits of that, potentially, right? But if the mood and the sentiment shifts to that risk off, right, because of what the Fed is doing and the United States dollar is the global reserve currency, and when people start saying, hey, we're risk off in the stock market, moving to more secure assets, then you can see that New Zealand dollar is suffering, right? Because commodity currencies typically during the risk off situation tend to decline more so than not. Okay, so we're moving down overall, right? You see, we're moving down. We had a nice run in the correction to the upside, right? And now we're moving back down. As a matter of fact, we just took out that support level. Okay. So what we just want to watch are the ebbs and flows as we move down through the charts. Okay. So we know, right? It made that run up, and that's exactly how we came into, right, these scenarios, that correction to the downside. So if this is going to possibly continue with the Fed doing this thing, if this continues to be a downside move, then this eventually here is going to become irrelevant, and you're going to start to see, right, the price just continue to move to the downside. Like so, okay, it's moving bearish. So sometimes if you get confused and, hey, I've got fibs running both ways, just go with whatever the current trend is. Use that fib to the upside as some landmarks, right, for you, those TP levels. But hey, in order for it to come down to those TP levels, it has to move bearish. So you can see we're in the middle of an ABCD wave to the downside. So that gives you greater clarity, then do that. Once you get your targets marked up on that 80-20 move, go ahead and delete that if you want to. You got your targets marked, and you can see here where we've clearly made a distinct break, right? And a move to the downside, okay? Like so. So now it's like, hey, now I have an ABCD move here. Look, A, B, C, I projected D is our 61.8. Uh-oh, I have to do that again. Right, so here, A, B, C, D. That 80-20 helps us to identify, it's an extra confirmation piece that, hey, I'm at a structural level, a pretty good high price is overextended, and there may be time for that reverse. Right, so it's still it still ran into. That's still important that it ran into higher time frame levels of structure. These blue lines here are weekly levels, and now we're moving to the downside. So when we play those 80-20s, that's a trend reversal, and the shift is now down. Okay, it's down, and then overall, what's going on with the dollar in regards to monetary policy? What's going on with the economy globally? This is moving to the downside to where eventually we may take out that A, right? Continued dollar strength, more uncertainty in the markets, we can continue to move to the downside. So then it's just a matter of, even though it's coming off of, right, this 61.8 zone, okay, to that D extension is 300 pips. We know that it's not going to move there in a straight line. Is going to do it in waves. That's 300 pips of price action. So this is when you can come down to those lower time frames for those intraday plays, right? And say, okay, here's the same wave here. Here's our ABCD wave overall. So let me take this out. Okay. If we're going to move to an extension over 100 pips, we know it's going to move in waves. So this C to D move is not moving like this, okay? It's moving like this. So this is where time frames and fractals come into play and how you can get in and out of those smaller setups. So this is the overall longer swing, but hey, as it moves from that C to that D, it's gonna do it in waves, right? So this is where you can have those smaller type of setups if you like them. If not, right, you're just holding your trade short and you're gonna just let these play out, right? So if you get this situation to where, see how we got this 236 retracement on this fib there? If it pushes down on the sub fib to this 118, 127 zone, there's a possibility that that may retrace, okay? So for a smaller setup, 15-minute, 5-minute, did 1 hour, you may say, hey, if it hits this level, I may want to play that back to the 382. This is the whole concept. And you literally can play it on any Forex pair, any asset, right? This is the same concept, the idea that the market moves in waves, right? So we just want to catch a wave. So you could play that, or you can say, I use these zones here. My overall bias is to the downside. That's what I want to do. I want to short. Well, if you get it to come into this 118, 127 zone, you can say, you know what? That's just my alert to let me know that this is probably going to eventually push to a high price. And once it gets to this high price in the zone, I'm going to look to short, right? Like so. So if I missed on this capital fib, right? We always call this our, I gotta get this out, sorry. So we always call this our capital fib. That's the main fib that's running. So if I miss this initial entry opportunity here, I can use the smaller waves to get a new high price to get involved in this move, right? So I can get involved in this move off of this fib here. Boom, that pulled back to a 61.8. Hey, I missed that initial entry on the capital fib, but now I can get involved here. It's giving me another chance, right? And if I get involved here, I've got some options. If I just like smaller setups, then I could take it from the 61.8 to the D extension that's right here. Let me move this out of the way. That's right here on this fib. Boom, that's a play. So from this C to this D is 87 pips. Or I say my capital fib, the extension is right here, okay, at 600 even. So when I get into this, yes, I'm getting in on this sub fib, okay? And yes, I can put my stop, if I'm getting in off this sub fib, I can put my stop above this A, but my overall take profit for that setup is gonna be right here, right? So now I've just gotten in off that sub fib. My stop loss is, what is that? Call it 30 pips or so. But my D extension is here, 233. So I can look at this, this current move as the potential for an 80-20 play. Nope, I don't want that. I'm already short. Well, if it pulls back on you, and we understand how waves work, if my bias is still to the downside, then when this pulls back, this current fib pulls back to the 61.8, if that's your sweet spot in your trade plan, I'm gonna add a position. Okay. I'm gonna add a position. And on this position, my TP is still here. Okay. So if this plays out according to my plan, right? 230 to that D extension. And off this entry, right? Looking at 179, 180, right? So that's multiple ways. Once you do your top-down analysis and you determine your trade plan for a particular pair, this is how you can compound that trade. So I don't have to, right? When I study the game, you don't have to trade and try to over leverage the account. As a matter of fact, you can trade using hardly any leverage and just compound, right? When you're trading with this trend to the downside, okay? So that's trading with the trend on this move. I'm short. From the top down, I see, hey, I'm having a bearish week. I've broken major support. This is moving down, right? So how do I get into that? Well, I would prefer to have a high price whenever I'm selling, right? And that's just us. That's when Seen that happen on the UJ. Yep. And that's just with anything in life. If I'm selling anything, if I'm selling a old coat, right? I want to get the highest price as possible, right, for it. So when we're selling, we look for a high price, and when we're buying, we're looking for a low price. That's why a lot of times, like for example, if you go to the pound CAD setup that we were going over last night, okay? So we looked at this pound CAD and said, hey, you know, we might be getting a correction, right, on this pound CAD. And you can see now how this price has reversed, right? So this B boundary represented, because what happens, everybody, right? And this is why it's so important, right, in your training that you get this concept. If, okay, let me blow this up. Okay. If I have an AB boundary, and then I have a C, and then I have a D extension that gets hit, and we know when that D extension gets hit, that we need to wait for the next swing low to form, right? For that to complete and exhaust, right? Boom. So what just happened? A, B, C, D. That extension point represents, right, exhaustion, right? Whether it's temporary, long-term, price is at this extension is exhaustion, which is why we say, hey, once that swing low forms, the market structure is based on swing lows and swing highs, that 5 candle combination. Because when it forms, it creates what? Support. That's all this is, right? So it's going to create support. So that's why we're not afraid to play counter trend trade type of setups, because we know that at support, and if we have an exhaustion point, a high probability exhaustion point, and we have support, we can possibly see what? A reaction, right? So look, A, B, C, D. Our C became our new A. Our D became our new B. We have a new AB boundary. That B boundary is support. So we know that's a potential reversal point there, okay? Where there's a short-term correction, or we're looking at a longer-term trend reversal. And that's why we say, hey, as long as price doesn't take out the A, it has no choice but to go your way. If it takes out that A, we may be looking for a longer-term move to the upside, which is maybe because of a deeper correction on a higher time frame, or the CAD may be ready to tank and we may get bullish for quite some time, right? So you have a reversal. So we say, well, we have the support zone here, first potential entry. But if it breaks that B boundary, we know that that 127 can represent an area of what? Exhaustion, right? It's kind of like a secondary exhaustion. We've crashed through one floor, now we're at another. So let's look and see, right? So we've got this whole zone here. We got the reaction here. But hey, it could have dropped and come back and retest support and reversed again, right? Reverse to the upside off this level. See? That's all we're looking at. Look at this impulse leg here, right? This was a play for us before. Boom. See what that did? Okay. And so that's why right now working with software to highlight these points. That's why sometimes you see them and they come through and they don't have this, it's a manual fib that's drawn. It's because we're working with software to find those setup, those extensions, and those reversal points, right? That we can post for everybody, right? And say, hey, this is a potential setup. And then you as a trader, you can base your plan around it, because that helps you to train and get the repetition. So before you know it, those training wheels come off and like, you know what, I got this, right? I've got confidence to take this trade, right? So just like that, and this is a pound pair too, when we identified this, just like that. And they say it's a lot of times, those 100 pip trades, right? 50, 60 pip trades, they could be hard to come by. Oh, the market's not trending. Oh, the market's inconsistent. All of that stuff that you hear, right? You can put it to bed, because at the end of the day, the market's going to move in waves. Whether it's in a large range and it's moving from top to bottom, bottom to top, or if it's trending to the downside, making lower lows and lower highs, or trending to the upside, making higher highs and higher lows, it's going to do it in waves. Okay? So that's what we do. That's why we don't change. You can go back as far as you want. Even when I was a part of IM Academy, and I was doing trainings on even when I was doing trainings on how, for the group that I was in, right? I was never IM educated, but in the group that I was in doing training, taking even the software that they had and saying, this is how you can apply the Fibonacci principles to the software, identifying a potential U-turn. Okay? So our whole goal is to say, hey, teach you guys, right, how to identify these U-turn points in the market. Okay, whether you're a long-term position trader on the higher time frame charts, whether you're a shorter term swing trader, whether you're just an intraday trader on a 5-minute, 15-minute chart, right? I hope everybody sees now, right, over almost it'd be 2 years before we know it, in a circle, that day after day after day after day, the market moves. Right? The market moves away. Okay, so that's that reversal on the pound CAD, and it's like, hey man, that's a good day at the office, right? Off that reversal. Okay, even if, how we talked about last night, you break it down into smaller positions, you made positive gains. Okay? So if you can make, right, when you guys get a chance, look up, to put it in perspective. Look up your average returns on the S&P. Look up the average returns for hedge funds and things like that. Okay, and see what those returns are. And then you think to yourself, learning what I'm learning, okay, even if I have a small account, right, and I grow it, and say you had a $2,000 account, and somebody tell me what the return is on a $2,000 account. If for the year, right? And I want you to think about this for the year, right? And we know the whole idea is to compound a little faster than that. But if for the year, if I had a $2,000 account and I gained 36% on that account, so somebody put in the chat what that would be. $720. I remember when I did those trainings. Yeah, it's like so long ago now. So long ago now. So that's $720, right? If you put that money in the bank, do you get those returns? No. Oh, you're welcome. Thanks for the feedback. If you put that money in, if you use the Acorns app and you roll over money, right? Every time you spend, you go shopping, they roll that money over, or you can make a reoccurring investment. Like I do that, right? Anytime I can save money, right? They put that into like a money market bank or whatever they do, right? Look in your Acorns account and see what you're getting right now on your return. Look at your TIAA Craft retirement account and see what percentage return you have this year. Scare me. That's a lot of zeros, right? That's the truth though. But so look at, and then think about, put it in perspective. And think about what you can do, right? If I think, hey, I got $1,000, if I could just steadily work, if I could start out at least trying to get 2% a month, 3% a month. Yep, I did used to do that with that scanner. Absolutely. You remember? Yep. I used to make that thing work. That thing work, man. For sure. So think about what you're doing as a professional, right? Think about that. So then it becomes, man, I can do that. Now that gives me incentive to, oh, I'm starting out with a small account, $500. I'm going to trade. You know what I'm going to do? I'm going to trade this in micro lots, because now I'm thinking of things in pips and percentage and overall return. And then things start to make more sense. So then you start to get motivated. Like, I don't care if I got to go around collecting and recycling cans. I'm going to figure out a way to get more money in my account. Why? Because if I get to the account where, man, if I could get to one mini lot, and that one mini lot, and I work out my risk, and I could trade at that one mini lot, and if I get stopped out, I'm only losing 1% or 0.5%. If I could get my capital to that point, well, man, if I could get 500 pips in a month, that's an extra $500. And then it just goes up from there. That's why you always hear Ryan say, trade small. There's no reason to try to hit the jackpot on your trades, because you have to give yourself more credit for the skill that you learn. And you have to believe in yourself. Because once you do that, or once you discover that you really have an edge, as long as you use proper risk management and enable yourself to stay in the game for your edge to play out, you'll be amazed at what your returns look like. Okay. So think about it. I'll show you guys a new, because you can have up to like 3 accounts, right? Let me, hold on. Share. I have to do a new share screen. Hold on 1 second, everybody. So, for example, okay. So for example, I'm gonna share my screen with you guys. So together, let's show. Okay. So this is a Fiverr's account, right? Now you can have up to 3 accounts with the Fiverr's. This is a new one that I'm working on, okay? To try to gain it, because I want to combine them, right? And grow them, put them all on a trade copy. But so for this one, right, when you look at this here in this month, right? So it's a 20K account. Okay, now this is what you have to realize. And these things are really good for teaching you how to really manage your risk. So this is 20K. I'm up right now, $578, right? So overall the history is 703, right? I got some losses, right? I lose trades, okay, stop out. But overall I'm up $578. And you may think like, wow, on 20,000, right? But this is really like your leverage, okay? So if you're thinking about doing a prop firm thing, think about this, okay? This is really like your leverage. Does anybody know what they give you? They give you drawdown limits, right? They give you maximum drawdown limits, okay? So if anybody's familiar with that, drop me a 1 in the chat with prop firms. So they're not gonna sit there and let you just blow $20,000, okay? So with the Fivers, does anybody know what this maximum drawdown limit is for a 20K account? Anybody know what it is? $1,200.
1,200, yeah, that's what I was gonna say.
Yep, it's $1,200. So when you divide it and you say, well, 578 on 20,000, right? You work your percentage from that. You're like, okay, right? Okay, I see that, right? But guess what? You're not trading 20,000. You know what you're trading? Can somebody tell me what you're really trading? And this, I think, is what blows people up with these firms. You're trading 1,200, Jeremy. Exactly. So now, look at the return. Take that 578. Somebody take that 578 and divide it by that 1,200. Tell me what that is. No takers?
Two. I got two.
David, right? So 578 divided by 1,200. 48. What is that as a percentage?
0.48%.
0.48. So what is that as a percentage when you look at return?
Okay.
48%. Right? That's 48%, right? Almost 50%, Jeremy, right? Okay. So when you look at it from that perspective, and I think that's where people get a little bit, hold on one second. Bring the screen back up. I think that's right. People don't understand. People don't understand that, hey, you're really doing a lot better than you think, right? Will anybody take a 48% return on their money? Right? So it's all about taking the proper perspective and realize what you're really doing, right? And you realize you're a lot better than you really are, right? So some of us, whether we've gone through prop firms or whether we've gone through, with our own accounts, a lot of times we're so anxious and we're not thinking about things in terms of percentage and pips, and we get frustrated. But it's like, if you really did the math, you'd be like, wow, on this small account, yes, I'm trading in micros, but man, that's like a 35, 40% return. I'm actually doing good. My issue right now is I just need more capital. Everybody follow me on that? Everybody get that? Yes, I hope, right? So you're actually doing good. And so that's why we always try to say, like, hey, you have to filter out, things like, well, I want this and I want that right now, or hey, I've got these bills to pay, or I got that'll mess you up. That'll drive you to take on extra risk that you really don't want to. The key becomes, man, how am I going to get some more capital account? Because I actually am pretty good, but I'm trading on micros, right? I've been getting 50 pips pretty consistently, but I'm only able to do it at 10 cents a pip. Man, if I could just get that to $1, that's $50, right? If I can get that to $5, if I can get that to $10, but I still want my risk to be 1 or 2 or 3% per trade because I've got to stay in the game. Your perspective changes everything, right? Having a proper perspective changes everything, right? So that's why we don't mind launching a trade and truly understanding, like, I don't control this. I've got my trade idea, but when and if it wants to go in this direction, how fast it wants to go in this direction, whether or not it takes a week or 10 days, I'm not worrying about it because my risk management is intact and I'm thinking of everything in terms of pips and overall percentages, right? If you can consistently get 2% a month, 3% a month, like 3% a month, let alone right? Man, 30%, 28%. Like, hey, you could do all right for yourself and your family. So just some things to think about as we close out the session. Any questions or comments? That's why you see Ryan will drop. He doesn't care. He doesn't care about, how big his account is. If his risk works out and it's supposed to be a 30-cent trade that he's going to compound later on this huge 300 pip move, right? Then that's what he's going to do, and he's going to stick to it because it's about the long game. It's about what happens over time, right? So, hey, great job tonight, everybody. Great questions, right? Awesome session. I appreciate you all being here. Hey, tomorrow we'll be right back at it. I know we didn't get through a lot of pairs tonight, and I hope that's okay. But we'll be back at it tomorrow, 6:30 a.m. Eastern Standard Time for the pre-New York session. Everybody have an awesome night.
Thank you, Benny.
Thank you, Benny.
You're welcome.